Hi, everybody. This is Bob Carey coming to you from First Trust offices here on Monday, the 6th of February. Markets are up significantly over the last couple of weeks. We've had a very good run. If you take a look at all of the measures of systemic risk, they have come down. In other words, Treasury rates have inched up a little bit, but at the same time, bond yields and all these different measures of just how much stress there is in the financial system, they've come down quite a bit here in the last couple of weeks. Earnings have been okay. 60% of S&P 500 members have beaten their estimates, which is down from what we've seen over the last couple of quarters, but still pretty decent. Earnings estimates are actually holding up for the rest of the year, which is also very good for the stock market. At the same time, the economic data, for the most part, has come in better than expected across the board. Even in Germany, for example, this morning, the factory orders report for the month of December was quite a bit stronger than expected. So a lot of cross currents. Of course, a lot of folks are still very concerned, very negative. But today's front page story from Bloomberg really captures the essence of the moment. There's still a lot of pessimism out there. A lot of investors are very nervous about thinking they're chasing this market at this point. And yet, when we take a look at the difference between what you earn sitting in cash and your cash or treasuries, playing it safe, and the return that you get from owning companies right now, there is a very, very big difference. Returns on balance sheets globally are in excess of 9%. They're over 10% for major U.S. companies. And so you've got very, very high returns on assets as a shareholder of most major stock market averages, and at the same time, very, very low returns by sitting in cash and playing it safe. So the opportunity cost is finally beginning to sink in for investors. We are beginning to see individual investor flow into the major market averages has turned around slightly. The market remains heavily dominated by the block share, large types of investors, trading firms in particular, have been the major buyers here over the last 6 to 7 weeks. But really, individual investors, up until the last couple of weeks, really haven't been all that interested in getting into the market. They still remain very, very negative. So with that, the question is really on valuations. Where are we at? I've talked about this quite a bit over the last several years, but it's even more so true today than it was even, say, a few weeks ago. When we take a look at all the companies that make up the market, we take a look at the valuations on companies in a variety of different ways. We typically use a discounted cash flow approach, but there's a lot of folks who use different metrics to value companies. But right now, it's quite clear that stable companies, think of utilities, consumer staples companies like a Procter & Gamble or a Coca-Cola. Those companies that really don't see a whole lot of change in their earnings. You know, they're very, very stable streams of cash flow that you earn as a shareholder in these companies. Their valuations tend to be on the high side right now. They are actually close to their average levels of price to earnings multiples going back over the last 20 years. When we take a look at anything that is cyclical or tied to the economy, or perhaps in markets that are highly competitive, or maybe even subject to perhaps more regulation and scrutiny over the next couple of years if public policy goes the wrong way. All the sorts of things that have more risk are selling now at much, much lower than average multiples of earnings. And that's really where the opportunity it can be found today. In fact, so far this year, that has been the play. It's betting on the economy, betting on a recovery. It's Europe bouncing back. Many of the emerging markets are bouncing back. And of course, U.S. equity is also bouncing back. So at the end of the year last year, we heard a lot of people say, well, stay close to home, invest in the U.S., don't take on a lot of risk. If you do get back into the markets, buy dividend stocks, buy defensive stocks. And that strategy has been absolutely dead wrong so far this year. Obviously, we're only 1 month or so into the year. There's a lot more to go yet. But based upon the numbers that we see from a risk return, from a valuation perspective, all those sorts of things, this trend that we've seen so far this year is not likely to die out anytime soon. It'll be later in the year that we start to perhaps see some of these markets begin maybe back into what we call fair value. But at this point, the cheap stocks in the market, the real opportunities remain the deep cyclicals at this point. So with that, we will check back in with you next week. And in the meantime, we'll talk to you then.